Time now to continue our series, Wall Street's Hottest Funds. Tom Ognar is the Senior Portfolio Manager of the Wells Fargo Advantage Growth Fund. He has a one-year total return of 39% and a five-year annualized return of 11%. Mr. Ognar joins us now from Milwaukee, Wisconsin. Sir, welcome to Bottom Line. Thanks so much for joining us today.
Yeah, hi, Mark. Nice to be here.
Mr. Ognar, I was reading some of the information, and it says that your criteria: robust growth, sustainable growth, and underappreciated growth. How do you find these criteria in the economic climate that we've been in for the past 2.5, 3 years?
You know, really, it's a blocking and tackling approach, Mark. We spent a lot of time meeting with companies. Actually, we met with your previous guest earlier in the week. We're meeting with companies constantly, and we do a screening process to try and identify companies that have a lot of those robust and sustainable growth characteristics, and then go and interview them, talk to them, do an analysis to try and figure out, is that sustainable going forward?
So you met with Mr. Sharples just recently. Any information, any news that you would care to break here on Bottom Line?
No, I mean, nothing other than I think, you know, he's got a market where he has a large first mover advantage, a large market share, and it seems like it's fairly small amount of penetration so far, giving him a pretty good opportunity to grow the company going forward.
Mr. Ognar, of your criteria again, the one that stood out for me was sustainable growth. Is that a sense where we have companies who are better able to weather the economic downturn, and they have put aside, for lack of a better term, a rainy day fund, so when we do come out of this, they are better positioned than their competitors to do well?
Well, that's one of the characteristics we look for, and we're trying to find those companies that can finance their own growth, that have balance sheets that are sustainable going forward, and hopefully aren't totally dependent on the capital markets to fund that growth. And what we found over time, and I really think you stress tested that in 2008, in the beginning of 2009, are those companies that are dependent upon the capital markets, the equity markets, the fixed income markets to fund their growth are in a little more of a difficult state than those companies that are internally generating cash flow or have that cash on their balance sheet to generate their future growth going forward.
Is that where a lot of companies tend to stop dead in their tracks, that they're basically too focused on the capital markets instead of what they are doing in their own building?
I think that's one of the things. I mean, we try and keep it pretty simple. We're looking for those companies at that part in their life cycles that have good growth prospects, not just for the next year or two, but hopefully for the next 3, 5, and 10 years, and then we try and marry in valuation along with that. Where do we feel like investors are undervaluing that growth going forward?
And sir, if I could get back to the overall economic picture, how difficult is it for a company these days to get that long-term vision, given what we're still trying to climb out of?
It's not easy, and I think you can't ignore that the overall economy is going to impact a lot of companies. We're trying to look kind of cycle to cycle. Those companies that can grow from point A in this cycle to point A in the next cycle, realizing the economy might have some impact on their business. But one, we don't want it to be binomial, so we don't want a bad economy to put them out of business and for the stock to go down precipitously. And two, we want them to be able to either be in very fast-growing markets or in markets where they can take a lot of market share through an economic cycle.
And there's a couple of companies we like, that you like, excuse me. Let's start with Praxair. You see 8 to 12% top line growth, 15% earnings growth, and you caution that the value of the stock is not fully reflected in the price. Why not?
Well, I think what a lot of investors miss on Praxair is that what we really view is we view it more as an industrial staple. And what I mean by that is the products they provide, hydrogen, oxygen, what are called industrial gases, really are the underlying building blocks for a lot of manufacturing, healthcare, technology processes that companies need to run their businesses. And Praxair and a number of other companies around the world have very strong competitive positions in providing that and are benefiting as you see emerging economies around the world really ramp up on their manufacturing and ramp up on their economies.
The long-term contracts that they have with a lot of their customers, is that something that should give investors a sigh of relief, meaning, I guess, that they are in it for the long haul?
Yeah, it really gives them a unique position. So in a big part of their business, they sign 10-year what's called take or pay contracts with customers. So Praxair is putting up a lot of capital to build a industrial gas plant alongside a steel mill or refinery plant for their customer,
right.
$150, $200 million. But in terms of doing that, they're getting a promise from that customer that over the next 10 years, that Praxair is going to earn a good return on capital of that capital, whether that customer's business is great or just good.
Mr. Ognar, you also like CarMax, and you say that the business model is hard to compete with. Why?
The more we look at CarMax, the more we feel like they really have a good, sustainable competitive advantage. That advantage is they are by far the largest purchaser of used cars in the United States and also seller of used cars in the United States. So if you think of it in equivalent to the equity or fixed income business, they're the ones who are seeing the markets being made, knowing where prices are going up or down, because they're buying and selling those cars continuously every day, much more than what their competition is. And because of that, I think they can respond to changing dynamic forces in the markets. Used car prices going up, used car prices going down, SUVs becoming very popular, or as we're seeing right now, SUVs becoming less popular.
Yeah.
Respond to that and reflect that in their buying and selling patterns and in their pricing much better than their competition can.
Yeah, and Mr. Ognar, in our last minute, Priceline.com, and I was talking to my producer, Pat Sheridan, about this, and one of the things that stood out for both of us, that you say that Priceline does not earn the majority of its revenues in the United States. I don't think a lot of people know that.
No, I think they've done a great job branding the U.S. property, the William Shatner commercials, the price chopping. But what I think a lot of investors maybe fail to realize is the vast majority of their profits, approaching 75%, come from overseas, are mainly related to a property they call an internet property they have called Booking.com, which sells hotel room nights in Europe and also around the world, and then another property that's really just starting to emerge and becoming an important growth driver called Agoda.com that focuses on Asia. So when you think about Priceline.com, and if you're going to invest in it, you should realize that the vast majority of their profits and the big part of their growth prospects are coming from overseas.
And Mr. Ognar, if I might take an additional 30 seconds just to get your thoughts about the second half of 2011 as we're bumping up against June 30th. At this point, is the stock market overvalued?
It's an interesting question. I would say I don't believe it's a valuation issue. I think based on our projections, we think the S&P has about $100 in earnings power as we're exiting 2011. Right now, the S&P is about 1,300, so that puts it about 13 times earnings. That is not a high number by historic standards, and compared to interest rates and bonds, it's actually a very low valuation number. The key question investors should have is that $100 number sustainable, and will it grow from there, or does that $100 in earnings power go to 90 or go to 85? Right now, based on the conversations we're having with companies, we still have a lot of confidence in that $100 number. But that's the question we're asking. Not is the market overvalued, but what is the true earnings power of the stock market and of companies, both in 2011 and in 2012.
Tom Ognar, he's the Senior Portfolio Manager of the Wells Fargo Advantage Growth Fund, joining us from Milwaukee. Mr. Ognar, thanks so much for your time. We appreciate it.